Welcome. In this chapter, we'll explore the essentials of board meeting and the powers vested in the board of directors under the Companies Act 2013. You'll learn about the procedures for convening meeting, the importance of quorum, the roles of key committee, and the restrictions and powers of the board. We'll also cover contributions to charitable and political funds, disclosure requirements, and rules around loans and investment. By the end, you'll have a clear understanding of how the board affairs of a company are managed by shareholders in general meeting and by directors acting collectively as a board. Directors meet regularly to discuss management and administration, ensuring decisions benefit shareholders, the company, and the public. Modern practice grants directors broad power, except for matters reserved for shareholders. The board's oversight ensures shareholder interests are protected and wealth maximization is pursued. The Companies Act 2013, specifically Section 173A of the Companies Act 2013 mandates that every company must hold its first board meeting within 30 days of incorporation. Subsequently, at least 4 board meetings must be held each year, with no more than 120 days between any 2 meetings. This ensures regular oversight and collective decision-making. For example, if a meeting is held on April 2, the next must be before July 30 and at least 4 meetings. Certain companies enjoy exemptions from the standard meeting requirement. One-person company, OP, small company, DOM company, and private startups need only 1 board meeting in each half of the calendar year, with at least 90 days between meetings. If an OPC has only 1 director, it is exempt from holding any board meeting. Section R. Companies must hold at least 1 meeting every 6 months, provided they are compliant with filing requirements. These directors can attend board meetings in person, via video conferencing, or through other audiovisual means as per Section 173. The law defines video conferencing as a facility enabling all participants to communicate concurrently and participate effectively. The system must record participation and proceeding, including date and time. However, certain matters may be restricted from being discussed electronically, as specified by the central government. Board meetings are held via video conferencing or audiovisual means. Several procedural safeguards apply. The company must ensure reliable connections and proper equipment. The chairperson and company secretary are responsible for security, identification, and recording proceedings. Notices must inform directors of electronic participation option, and directors must declare their intent to join electronically. At the meeting start, a roll call confirms each director's identity. Quorum is the minimum number of directors required to validate board proceeding. According to Section 174, the quorum is 1/3 of the total strength or 2 directors, whichever is higher. Fractions are rounded up. Directors whose positions are vacant are excluded from the count. The quorum must be maintained throughout the meeting. For Section R, company, the quorum is 8 members or 25% of total strength, whichever is less, but not fewer than 2. These rules. Vacancies reduce the board below the quorum. Remaining directors may act only to increase their number or call a general meeting. When interested directors, those with a conflict of interest, make up 2/3 or more of the board, the quorum is the number of non-interested directors present, but not fewer than 2. For private companies, interested directors may participate after disclosing their interest. If a meeting lacks quorum, it is automatically adjourned to the same day, time, and place. Section 173 requires at least 7 days written notice for board meeting, delivered by hand, post, or electronic means to each director's registered address. Shorter notice is allowed for urgent business, but at least 1 independent director must be present, and decisions are finalized only after ratification by an independent director. Notices must inform directors of the option to participate electronically, if a director does not specify electronic participation. Let's look at practical examples. A company can hold a board meeting at any location, including via video conferencing, provided all legal requirements are met. Notices can be sent by email if permitted by the Articles of Association. For urgent matters, short notice is valid if an independent director is present. Courts have upheld the right of directors to participate electronically, provided the company has the necessary infrastructure. These examples highlight the flexibility. All matters require a physical board meeting. Section 175 allows resolutions to be passed by circulation, provided the draft resolution and supporting document are sent to all directors at their registered addresses. Approval by a majority of eligible directors is needed. However, if at least 1/3 of directors demand a meeting, the resolution must be discussed at the board meeting. All resolutions passed by circulation must be noted in the next board meeting. Section 177 requires certain companies to form an audit committee. This includes every listed public company and public companies with paid-up share capital of 10 crore or more, turnover of 100 crore or more, or outstanding loans, debentures, and deposits exceeding 50 crore. The audit committee must have at least 3 directors, with the majority being independent. Its members, including the chairperson, must be able to read and understand financial statements. The board. Audit committee's responsibilities include recommending the appointment and remuneration of auditors, reviewing auditor independence, examining financial statements, and approving related party transactions. It also scrutinizes intercorporate loans and investment, oversees internal controls and risk management, and monitors the use of funds raised through public offer. The committee can seek professional advice and has full access to company records. auditors, and key managerial personnel mechanism is required for listed companies and certain other classes. It allows directors and employees to report genuine concern, ensuring adequate safeguards against victimization. Companies with an audit committee must have the committee oversee the mechanism. Others must nominate a director for this role. The mechanism must allow direct access to the audit committee chairperson in exceptional cases. Details of the vigil mechanism must be disclosed on the company's website and in the board. Section 178 mandates that every listed public company and certain public companies form a nomination and remuneration committee, NRC. The NRC must have at least 3 non-executive directors, with at least half being independent. The chairperson of the company cannot chair the NRC but may be a member. The NRC formulates criteria for director qualification, recommends remuneration policy, identifies candidates for directorship. Companies with more than 1,000 shareholders, debenture holders, deposit holders, or other security holders must form a Stakeholders Relationship Committee, SRC. The SRC is headed by a non-executive director and includes other members as decided by the board. Its main function is to resolve grievances of security holders and protect their interests. The chairperson or an authorized member must attend general meeting. Inability to resolve grievances in good faith. Section 179 gives the board authority to exercise all powers the company is authorized to exercise, except those reserved for shareholders. The board's powers are subject to the Companies Act, the company's memorandum and article, and any regulations made by shareholders. Certain powers must be exercised by board resolution, such as borrowing money, investing funds, granting loans, approving financial statements, and approving mergers. Shareholders can impose restrictions or conditions. Board may delegate certain powers, such as borrowing, investing, and granting loans. The committee, the managing director or principal officer, subject to condition. However, shareholders can restrict or condition the board's powers through general meeting resolution. This ensures a balance between efficient management and shareholder oversight. For banking companies, certain exemptions apply regarding deposits and interbank transactions, recognizing the unique nature of their business. Section 180 imposes restriction on the board's powers in certain matters. The board must obtain shareholder approval by special resolution to sell, lease, or dispose of the whole or substantial part of the company's undertaking, invest compensation from mergers outside trust security, borrow money beyond specified limit, or remit debts owed by directors. These restrictions ensure that significant decisions affecting the company's asset or liability are made with shareholder consent. Section 181 allows the board to contribute to bona fide charitable and other funds, provided the total does not exceed par the average net profit of the preceding 3 years. If the contribution exceeds this limit, prior approval by an ordinary resolution in a general meeting is required. The law permits contributions even in loss years, as long as the average profit over 3 years is positive. This ensures responsible philanthropy aligned with company. Section 182 governs company contributions to political party. Any company, except government company, and those less than 3 years old, may contribute any amount to political party, provided a board resolution authorizes it. Contributions must be disclosed in the profit and loss account and made via check, bank draft, electronic clearing, or proof scheme. Indirect contribution, such as payments to persons supporting political parties or advertisement. Section 183 empowers the board and other authorized person to contribute any amount to the National Defense Fund or other government-approved funds for national defense without limit. This power overrides restrictions in sections 180, 181, and 182. All such contributions must be disclosed in the company's profit and loss account for the relevant financial year. This provision ensures companies can support national interest without proceed. Directors act as trustees for the company and must disclose any interest in other companies, firms, or associations. General disclosure is required at the first board meeting attended, at the first meeting of each financial year, and whenever there is a change. Specific disclosure is needed when a director is interested in a contract or arrangement. The disclosure must be made at the relevant board meeting, and the interested director must abstain from discussion and voting on the matter. A director fails to disclose their interest or participate in a meeting where they are interested, the contract is voidable at the company's option. The company, not the director, decides whether to rescind the contract. Contravention attracts a penalty of 1 lakh. However, if a director's holding in another company is do petition or less, disclosure is not required for contracts between the two companies. These rules promote transparency and prevent conflicts of interest. Section 176 protects actions taken by a director, even if their appointment is later found invalid due to defects or disqualification, provided the company was unaware at the time. However, actions taken after the company becomes aware of the invalidity are not protected. This safeguard ensures continuity and protects third parties dealing with the company in good faith while preventing abuse by directors who know their appointment is invalid. Section 185 prohibits companies from directly or indirectly advancing loans, including book debt, or giving guarantees or securities for loans to directors, their relatives, or firms in which they are partners. Exceptions exist for loans to managing or whole-time directors as part of service conditions or approved scheme, and for loans in the ordinary course of business at market rate. Violations attract heavy penalty, including fines and imprisonment for defaulting officers. Section 186 limits the aggregate amount a company can loan, guarantee, or invest to SA, petition of its paid-up share capital, free reserves, and securities premium, or petition of its free reserves and securities premium, whichever is higher. Exceeding these limits requires prior approval by special resolution in a general meeting. Loans to employees, other than directors, are exempt if they follow company policy. Details of such transactions must be disclosed. Every company making loans, giving guarantees, providing security, or making investments must maintain a register in Form MBP though. Entries must be made within 7 days of each transaction and kept at the registered office. The register is permanent and must be authenticated by the company secretary or an authorized person. Members can request extracts for nominal fee. This ensures transparency and accountability in the company's financial dealing. Loans under Section 186 must carry an interest rate at least equal to the yield on government securities of similar tenor. Companies in default of deposit repayment or interest cannot make new loans, guarantees, or investments until the default is cleared. These provisions ensure responsible lending and protect the interests of depositors and creditors, maintaining the company's financial integrity. Section 186 does not apply to loans, guarantees, or investments by banking, insurance, or housing finance company in the ordinary course of business or to investment company. It also exempts investment in right shares and certain transactions by non-banking financial company. Government companies engaged in defense production or those with prior government approval are also exempt. These exemptions recognize the specialized nature of certain businesses and regulatory framework. Section 187 requires companies to hold all investments in their own name, with certain exceptions. Shares in a subsidiary may be held in a nominee's name to maintain statutory member limits. Companies may also deposit securities with banks for collection or transfer, or as security for loan. Investments held in the name of depository must be recorded in a register, Form MBP, which is open to inspection by members and debenture holders. This ensures trust. Section 188 and related rules define related party broadly, including directors, key managerial personnel, their relatives, firms, companies where they hold significant interest, and certain associated entities. Transactions with related parties include sale or purchase of goods, property, services, leasing, agency arrangement, appointments to office or place of profit, and underwriting. The law aims to prevent conflicts of interest and ensure that such transactions are. Related party transactions must be approved by the board through a resolution at a board meeting, unless they are in the ordinary course of business and at arm's length. If the value exceeds prescribed limits, such as thus petition of turnover or net worth for certain transactions, prior approval by an ordinary resolution in a general meeting is required. Directors interested in the transaction must abstain from discussion and voting. These procedures ensure that related party transactions are sub. A related party transaction is conducted in the ordinary course of business and at arm's length, meaning it is as if the parties were unrelated. No special approval is needed. The law defines arm's length as a transaction conducted as if the parties were unrelated, ensuring no conflict of interest. This provision allows routine business transactions to proceed smoothly while focusing regulatory scrutiny on potentially problematic deals. Related party transaction requiring board approval. The meeting agenda must disclose the name of the related party, nature of relationship, contract details, material terms, pricing, and any advance payment. All relevant factors must be considered and documented. This ensures that the board makes informed decisions and that the process is transparent to shareholders and regulators. Certain thresholds trigger the need for shareholder approval by ordinary resolution. For example, sale, purchase, or supply of goods exceeding thus petition of turnover, or property transaction exceeding thus petition of net worth require approval. Leasing or service transaction above thus petition of turnover and appointments to office or place of profit with monthly remuneration over do par lakh also require shareholder consent. These thresholds ensure that significant related party violations of related party transaction rule or failure to obtain required approval can result in contracts being voidable at the company's option and penalties for the company and defaulting officers. The law is designed to deter self-dealing and protect the interests of shareholders and the company as a whole. Proper procedures and documentation are essential to avoid legal and financial consequences. Summary: the Companies Act 2013 provides a comprehensive framework for board meeting, powers, and related governance matters. It balances the need for efficient management with safeguards for transparency, accountability, and shareholder protection. From meeting procedures and quorum to committee roles, powers, restrictions, and disclosures, each provision aims to ensure that companies are run in the best interests of all stakeholders. The takeaway include the importance of regular board meetings, proper notice and quorum, the formation and functioning of key committees, and the need for transparency in related party transactions and director interest. The law provides flexibility for different company types while maintaining strict standards for larger and listed companies. Understanding these rules is essential for directors, officers, and anyone involved in corporate governance. Practice, these provisions mean that directors and officers must be diligent in following procedures, maintaining records, and ensuring compliance. Proper documentation, timely disclosure, and adherence to approval processes are crucial. The penalties for non-compliance can be significant, affecting both the company and individual. Staying updated with legal requirements and best practices is vital for effective governance and risk management. Recent legal cases and regulatory updates continue to shape the interpretation and enforcement of board meeting and power provision. Courts have clarified issues such as the validity of electronic participation, the scope of director disclosure, and the consequences of procedural lapses. Staying informed about these developments helps companies adapt their practices and avoid legal pitfalls. Directors should strive to attend as many board meetings as possible, disclose all relevant interests, and ensure that all decisions are properly documented and approved. Continuous absence from meetings can lead to vacating office. Directors must also be vigilant about related party transactions, loans, and investment, ensuring compliance with all statutory requirements. Good governance starts with informed and responsible directors. Company secretary plays a crucial role in ensuring compliance with board meeting procedures, maintaining statutory register, and facilitating communication between directors and the board. They are responsible for sending notices, recording minutes, and safeguarding company records. Their diligence supports the board's effective functioning and helps the company avoid legal and regulatory issues. Accurate and timely documentation is the backbone of good corporate governance. From meeting notices and minutes to registers of loan, investment, and director interest, every record serves as evidence of compliance and due diligence. Proper documentation not only fulfills legal requirements, but also builds trust with shareholders, regulators, and other stakeholders. Understanding the rules and best practices for board meetings and powers is fundamental for anyone involved in company management or governance. As you move forward, apply these principles to ensure your company operates transparently, efficiently, and in compliance with the law. Stay updated with legal changes and strive for continuous improvement in governance standards. Thank you for joining this comprehensive overview of board meetings and power.